The Monetary Policy Committee concludes their three-day meet today, and Gill Marcus will be making a statement a little later about the MPC's decision on interest rates. Here to preview the decision with me is Tendani Mantshimuli, consumer economist at Liberty. Tendani, thank you so much for joining us today. It seems that most people are expecting no move on the interest rate front. In November, we saw a cut to 5.5%, and that's the repo rate in South Africa right now. Your view on this, because many are divided as to whether we could see another cut in 2011.
Well, I'm not expecting a cut this afternoon, and certainly not into 2011. I think we've seen the last cut that we've seen in November last year. I think when you look at the economic data that came out, particularly the low inflation and upbeat in retail sales, both retail and wholesale trade sales are up, meaning that we're seeing some spending getting back into the economy. It's true that the economy still needs some stimulus, but I think what she's given up to so far is enough to boost it, and consumers are coming back into the market. What we do need, however, is to see an increase in employment, because you're not going to sustain consumer spending based only on interest rate, and that helps consumers that do have jobs. The biggest problem we have, I think, is people who are without jobs and who cannot spend.
Given the fact that the Reserve Bank has started to become a bit more flexible in terms of its mandate, many are expecting a very strong message from Gill Marcus with regards to employment. What are you expecting?
Well, I'm expecting to say that if you keep a prudent monetary policy stance, this helps the economy to grow. This helps the economy not only in the short term, but sustain growth going forward. However, one cannot look at interest rate as the silver bullet that is going to solve all economic ills in the country. You cannot look to the Reserve Bank to solve employment problems by cutting interest rates. This has to be a joint effort from government, from labor, because the biggest complaint you hear from employers, both big and small, is that the current labor laws as they stand do tend to be an impediment into recruiting new people into the workforce. So I think that's not going to come from the Reserve Bank. However, she might point out to that, and I do believe she has to point out that the Reserve Bank alone cannot solve the employment problem.
So does this mean that perhaps we'll see interest rates remaining flat going forward? Of course, something that cannot solve all the problems could definitely contribute to the spending and the power of the consumer.
I mean, we've seen the retail spending that we've seen in the last quarter is definitely a testament.
Did it beat your expectations as well?
Yes,
you weren't expecting 7.8.
We didn't expect that it would be that buoyant. Definitely the interest rate cut that we've seen are starting to bear fruit, in the sense that consumers have a little bit more in their pocket to spend. However, my point is that that is not going to be sustainable if you don't create jobs. If this economy doesn't start adding jobs, replacing those that were lost, and absorbing new entrants into the market. So while I'm saying that you can't look at interest rate alone as solving the problem, they're definitely going to contribute going forward.
Well, what about the Rand? Let's look at the Rand. And we had Joseph Stiglitz in studio a couple of days ago, and he alluded to the fact that the Rand should in fact be used as a mechanism going forward to assist in employment. And because all the forces are changing on a global level, emerging markets are starting to become far more versatile with their currencies and getting involved. We shouldn't be only leaving it up to market forces. What is your response to that? Do you think it's a wise idea?
Intervening and depreciating the Rand is always debatable. How far will you depreciate it? But I do understand the arguments that part of the reason why the manufacturing sector didn't do as well as it could have, why mining houses didn't benefit from the boom in commodity prices, was because of the strong Rand. And we know those are labor-intensive industries. So you want the Rand to be a little bit less stronger than what it is currently. Whether the bank should go in and start intervening directly, because I think they are accumulating reserves at the current strong Rand. However, if we're looking at something like what I've heard Kosato saying, something alluding to a kind of a Tobin tax, I think that hasn't been proven to work yet for Brazil, which has introduced it. So that is a debate that is still going to go on for some time.
It's also quite interesting to note that inflation on a global level is starting to become a big problem for some emerging markets. And interestingly enough, UK inflation is now above what we saw in South Africa for the month of December. The Eurozone citing the same issues. Is this going to be a reality in South Africa? Do you think that perhaps we should be grateful for a slightly stronger Rand?
Well, I think definitely there's no question that the Rand did mitigate some increases in commodity prices and some higher food inflation that we've seen boosting inflation in Europe and all those other economies, other emerging economies. So we did benefit from the strong rand. We shouldn't forget it. And the important thing is that inflation benefits a larger portion of the population, particularly the poor in South Africa. The very same people who COSATU represents.
So why do you think that is? Why do you think that the unions are calling for a weaker rand and perhaps even moving away from inflation targeting?
I think the debate gets clouded in the sense that you want to protect the jobs that are currently on the books, and you do forget that you represent the poor in the broader sense, that there are more poor people outside of COSATU's ranks than there are within the
Tendani, I mean, I was talking to James Turp a little earlier, and he pointed out that the interest rate derivatives markets showing perhaps an interest rate hike priced in November. Is that going to be a reality? And then also a question I posed to him, that our growth rates are not nearly as high as what we've seen in China, 9.8%, in Brazil and all the other countries that have started embarking on interest rate hikes.
I do think inflation is going to be up this year, but certainly around the 4.8, 4.9 region compared to what we've seen for 2010. However, as far as a rate hike in the last meeting of the year, that is still debatable, because I think this is within the Reserve Bank's plan. They've foreseen inflation coming up at 4.8%. However, the key will be the statement that we see this afternoon. What is the new forecast saying from the Reserve Bank?
Tendani, it's been an absolute pleasure to chat to you. Thank you so much for joining me.